who typically is a good fit for this type of an investment?
If I had to pick an avatar, so to speak, or a stereotypical type of person who would be interested in this type of thing, typically it's someone who is a relatively high income earner, and they are looking for a lower risk investment that's not correlated with the public market as a way to diversify their overall portfolio. So that is a type of person who could be a great fit for this type of private real estate investment. The other component to that, if they're a relatively high income earner, they're probably taxed at a high income tax bracket. And again, through the benefits that we can create through depreciation, that can help reduce the effective tax rates that investors are paying over time, and thus create some efficiencies within your overall personal portfolio.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. I am today's host, Nathaniel Leach, along with my partner, Tim Bickmore. And today we have a special guest, Giorgio Hopkins. So I'm going to read Giorgio's bio here real quick, and then we're going to get rolling into the exciting world of commercial real estate. I know it doesn't sound all that exciting, but after this, we think you'll be very interested. So with that, Jorjio Hopkins is a Wisconsin native who served as a captain in the United States Marine Corps for 8 years. Hoorah! Giorgio has a passion for real estate investing and a master's in real estate. So far in his career, he has completed in-depth investment and market analysis on over $5 billion worth of commercial real estate assets, primarily focused on the multifamily space. Giorgio currently works for the MLG Capital, a 35-year-old private real estate investment firm with over $4 billion in historical CRE transactions nationwide. At MLG, Giorgio primarily works with current and prospective investors, while also working closely with the acquisitions team to find and close great investment opportunities. Giorgio, welcome to Critical Thinking Required.
Thank you, Nathaniel. It's a pleasure to be here. I'm excited to talk about private real estate. It's a big passion of mine. So anytime I get the chance to connect with you, first of all, you as well, Tim, and get to talk private real estate, I feel like it's a real treat. So thanks for having me.
Great. So before we dive into the good stuff, I'm going to do our typical plug for our listeners and viewers. So if you are watching, listening, please, as Tim likes to say, please, subscribe, give us a thumbs up, do whatever it takes. We'd love for you to listen to us and continue viewing us, and just enjoy yourselves while doing as such. So with that, Tim, do you want to take it away?
Happy to. Giorgio, I'm excited to talk about private real estate too. But I guess my first question is pretty easy. I don't know if it's an easy one, but it may be what I think our listeners and viewers are looking at. Like, what is private real estate? What give us some landscape on what you're doing at MLG.
Yeah, I love it, Tim. Great question. It's a good one to start with to kind of lay the foundation. So ultimately, when most people think of real estate, they think about, buying the single family home or the duplex down the road and, cranking on the faucet or, calling the plumber because the toilet overflowed in the middle of the night. So they have a tenant that's calling them and they're managing everything on their own. So the world of private real estate is essentially investing in real estate in a more passive way to where you are more hands off. So you're not the one answering the phone and the tenant calls, or you're not the one who's actually doing the repairs or renovating, like they do on HGTV, fix and flip type shows. So you're not doing any of that hands-on work. You actually are just allocating capital to make an investment into a real estate transaction to then be passive in nature And we can dive into the components of that a bit more. But essentially, it's just an alternative investment strategy than the typical equities type of investment.
Okay, so let's take a little bit deeper dive into it. Like what different forms can this type of investment take? I mean, what are we kind of looking at? Because and I know some of our listeners may have heard of REITs, so like a real estate investment trust. Sometimes those are publicly traded, sometimes they're non-publicly traded. So I'm just kind of curious on different forms that this sounds wonderful passive investment, so I don't have to be answering the phone calls in the middle of the night because the plumbing's broken. So could you just kind of explain a little bit of how the forms it could take?
Yeah, absolutely. So ultimately, to your point, Tim, you have REITs, which are typically publicly traded. There are some non-publicly traded private REITs as well. But how those are structured, they're essentially pools of capital. So people buy shares of the REIT. You're essentially pooling your capital into this vehicle. The REIT entity is then going out to acquire real estate transactions that are cash flowing in nature. So essentially, because of the tenants at the existing assets are paying a rent on a monthly basis, now the assets cash flowing to produce a return or a dividend distribution to investors that have invested in that REIT. The same thing is true throughout the world of private real estate. So there's a few different structures that you typically see. There's three main ones. One being a crowdfunding structure, to where you're doing something very similar, but you're essentially allowing for individuals to buy into real estate at a lower dollar amount. And then there's a syndication vehicle. So where you find maybe the 100-unit apartment complex down the road. Well, maybe it's just not one person that owns that asset, but maybe it's a group of 100 people that own a small percentage of that asset, and most of them are passive investors. So it could be someone that syndicated that deal. The third structure is really like a fund structure, and it's a private real estate fund structure, and that's really what we do here at MLG. But essentially, we have a fund where investors can allocate to the fund. We have an overall investment thesis or a strategy for what we are choosing to invest in that we essentially communicate to those investors up front. And then due to our track record and experience, then they choose to trust us in going forth and placing that capital to then be able to produce a return on investment for those investors. So those are kind of the three main types of vehicles that you'll see throughout the commercial real estate space.
Just out of curiosity, when it comes to the three that you just mentioned, so crowdsourcing, syndicate, fund, what are some of the pros and cons to each, and how does somebody like MLG pick to go the fund route, or to syndicate an investment, or to crowdsource it?
Yeah, great question. So there's different regulations for every single offering that you bring forward. The Securities and Exchange Commission, or the SEC, regulates all of these offerings. And oftentimes timing is of the essence. And so when you look at a Reg A or a Reg CF, or Reg crowdfunding is the term for the CF, but typically those transactions take a long time to register with the SEC for and get approval for creating those structures. But real estate transactions, and if you guys or anyone in your audience has ever bought a single family home, it's typically you get it under contract and you're closing within 60 to maybe 90 days from getting that asset under contract. So time is of the essence. You don't necessarily have the time to get an asset under contract and then go out and crowdfund for 6 months, file for the SEC and wait for 6 months for approval, and then go out and close on that real estate transaction. So there's different timing elements involved, and there are ways to circumnavigate that. But the reason why we chose the way that we do it with a fund structure, there's a regulation, and without getting too complex, it's just called Regulation D506C exemption, meaning that we are exempt from filing, which allows us to essentially create an offering without that long leadway of file time. So now we create an offering, especially with this fund structure, and now we can start getting investors in the door right away, and then start acquiring once we have capital in the fund, acquiring assets right away. So the biggest distinction between why we choose that over, because the individual syndications and the funds are operated under the same regulations, why we chose a fund structure over a syndication structure is mainly because of diversification. So if you think about, I have $100,000, can I invest that $100,000 in this building, or the same example from before, the 100-unit apartment complex today? Yes, sure, I can certainly invest that there, but now my basis in that one property is $100,000. So the location and the economies of that one building and that one local environment is very, very critical. Or can I take that same $100,000 and invest it in a fund that now is going to invest in 25 different assets across the country? Now there's geographic diversification. Maybe they're buying multifamily, they're buying industrial, maybe some office, maybe some retail, or whatever it is within the commercial real estate space. And now you're diversified in multi facets, right? So that's ultimately why we chose the fund structure, is to lower the overall risk involved from a diversification standpoint.
Very interesting. Great answer, by the way. You nailed that. You simplified it pretty, even with the regulations, like, dang, that was great. And so I just because I know I feel like a lot of our listeners or viewers or people that we usually talk to do know the REIT model, right? So the real estate investment trust model, which is the publicly traded. Can you just give our listeners and viewers some pros and cons from the private fund model, like an MLG, versus like a publicly or non-publicly traded REIT?
All right, Tim. So great question. The difference between a real estate investment trust, a real estate investment group, and what we do in private real estate, and then the pros and cons of both. Ultimately, REITs, especially publicly traded REITs, are far more liquid. So that's a big, oftentimes at least clients see that as a big benefit, is, hey, I can trade in and out of this pretty quickly, right? Just as quick as you can trade any stock. And it's just extremely beneficial in being able to view the value of your portfolio in a snapshot, in an instant. Whereas in the private, if you compare that same thing for the private real estate space, it's far more illiquid in the private real estate space, because you're allocating capital to an investment that's a tangible investment, but you're doing so in a single transaction or in multiple transactions if it's a fund structure, but still now the money is tied up in those transactions. There's no liquidity, whereas in a REIT, there's constantly people buying and selling assets, so there's constantly liquidity, not so much in private real estate. So you're typically locked up for the duration of the holding period of the asset or of the fund.
Yeah. So I guess it would just be more like an MLG structure. So it's a private fund. It's not publicly traded. And so just looking at why, so again, you kind of talked about like, hey, REITs have a lot of this liquidity and it makes sense. Yep. You can see your portfolio. So then as an investor, why would I be like, well, why would I care about these private funds? That doesn't make any sense. I don't want to lock my funds up for 7 to 10 years or whatever it may be. So I'm just curious on what the benefits to the private side would be compared to this liquid REIT structure.
Yeah, great question. And so ultimately it boils down to return structures being, when I'm deciding which one's a better fit for me, I'm deciding, okay, based on there's a number of factors, risk tolerance, based on my time horizon, similar things to what you guys deal with as wealth managers, right? You're asking all these questions. Hey, what's your risk tolerance? What's your time horizon? Are you trying to retire in 10 years, 20 years, 30 years from now? And then trying to figure out, okay, what's the best fit? So looking at that same lens, now we look at, okay, with a real estate investment group, I know that the money's going to be tied up for this amount. They're planning to execute on this strategy to produce X amount of return. I'm okay with having my capital illiquid for that period of time because of the other benefits involved, which we can dive into in a moment. But every return structure is different, is the point I want to highlight before diving into this, because there are some groups that give you access to, maybe it's a stabilized return. So maybe it's a 9% annual return, but that's all. There's no potential upside from profits of a sale, for example. And there's other groups that structure it in a way to where there's an equity waterfall based on performance. And so you have access as an investor to the upside within a transaction. And so we'll take an example, a recent example that I actually was just looking at. It was a project that a group had brought to our company out in Arizona. And ultimately, the group was pitching the deal, and they were saying, we plan to essentially double investor capital in the next 5 years with this real estate transaction. Okay. The return structure specifically was a 6% preferred return with a 70-30 profit split. So this is where the waterfall comes into place after the 6% return, meaning that every additional dollar of profit is now split 70 cents on the dollar to investors, 30 cents on the dollars to the sponsor, the group putting together the deal. But if they performed over a 15% IRR, internal rate of return, for their investors, then it waterfalls to a 50-50 profit split for, again, 50% to investors, 50% to that sponsor putting together that deal. So performance hurdle, but again, all in the return structure. So return structures are very important to realize. But so the benefits of private real estate are appreciation. So essentially, over the last 100 years, if you look at a chart, assets have appreciated, especially over the last couple of years. If you own a single family home, for example, look at how much your home has appreciated in value. I think nationwide numbers, household appreciation was in the double digits this past year. So significant amount. That means if you owned a $100,000 home, now it's worth $110,000. Or if you own $1 million home, now it's worth $1.1 million without necessarily you doing anything but owning that real estate asset. So that's one benefit, is appreciation. Another benefit is the tax benefits. And this is actually the most exciting component that you don't necessarily get from a REIT, investing in a real estate investment trust. And so the tax components, are you guys familiar with depreciation? And I can dive into the components of that. But ultimately, for your single family home, for example, there's a depreciation schedule. Usually for residential properties, it's depreciated based on so they'll essentially take a lot, and based on the structure of the lot, which is a percentage, so it might be 80% or 90% of whatever's on the lot, the land making up the remaining, then they depreciate the value of that structure over 27.5 years. So $1 million, for example, is the value of the structure. Then they'll take that divided by 27.5 years, and that's the annual depreciation that you can take. In private real estate, we use what's called a cost segregation study, which essentially allows us to bring a professional in to break down the components of that structure down to its depreciable life. So every light bulb has depreciable life, every countertop, every piece of flooring, everything in the building has depreciable life. And we can break down all those components. And with current tax laws, we're able to accelerate the depreciation down from the 27.5 years to anywhere from 5 to 7 years, depending on the component. But then with current tax laws, again, we can actually take bonus depreciation in the first year of the investment. So typically, we're able to create what's called a paper passive loss for investors the first year of their investment in private real estate. What that does for you is it helps to offset cash flows that you're receiving from the investment, but also could help to offset other passive income within your portfolio as well. And I'll stop there for any clarifying questions there.
Honestly, I think you did a great job actually explaining that. There is some components, and the depreciation also is the cost segregation is really interesting to accelerate that to increase your returns, which is fantastic. Now, with that all being said, like the pros and the cons, right, is that obviously the liquidity, you have to think about that. I like how you talked about the deal flow and the structure, making sure what understanding what you're going to receive. But when it comes to, again, getting this type of real estate exposure within someone's portfolio, and I know that you mentioned it's dependent on your risk tolerance and all that, but who typically is a good fit for this type of an investment? So if you had a prospective person coming to you, would you be like, typically they're going to look like X, in general? I know it's going to be customized to the individual, but could you just kind of give us a general idea of where this is typically a good fit for a household or for an individual who may want to get involved in this type of investment?
Yeah, phenomenal question. I really like it. And if I had to pick an avatar, so to speak, or a stereotypical type of person who would be interested in this type of thing, typically it's someone who is a relatively high income earner, and they are looking for a lower risk investment that's not correlated with the public market as a way to diversify their overall portfolio. So that is a type of person who could be a great fit for this type of private real estate investment. The other component to that, if they're a relatively high income earner, they're probably taxed at a high income tax bracket. And again, through the benefits that we can create through depreciation, that can help reduce the effective tax rates that investors are paying over time, and thus create some efficiencies within your overall personal portfolio through, again, your investment in a private real estate structure. And to circle back, sadly, REITs don't have that same capability of producing those same tax benefits. Those tax benefits are typically trapped at the REIT level, so you're not getting the benefit on your year-over-year tax returns. So you're not creating the same tax efficiencies.
Wow. Oh, I mean, oof. Okay. A lot of information, a lot of good information, as Tim was saying. Can you maybe go into beyond what you've already discussed so far, maybe go into more of like so that ideal investor, when they come to you, what do you typically explain to them about this? Is there anything else about the actual fund structure? Like, for example, you mentioned 25 diversified locations as an example within a fund instead of just one REIT that's in this one property. Can you expound more about that kind of structural setup that you would tell a prospect?
Yeah. So I think the big thing to highlight for most investors, and the difference between investing in individual deal and the fund structure, is the risk involved. And I know we talked about that before, but that's kind of the main highlighting factor. But then we just talk about their personal situation and their aspirations. So what type of returns are you looking for? And we try to determine if the product that we offer at MLG is a good fit for what they're looking for, their appetite for returns and their risk tolerance, et cetera. So again, we're a lower risk group, and we could talk about the components to how we dial back our risk here in a moment. But ultimately, higher risk assets typically should produce a higher reward, right? So if you're investing in, we'll call it, and I know we haven't defined like a Class C asset, but let's just say it's a rundown apartment complex in a part of town that may be on the edge of, turning over and becoming a decent part of town. Well, now there's a lot of risk involved with bringing capital in to revitalize that asset, to make old new, so to speak. And in doing so, from an investment standpoint, you should be expecting a much higher reward than if you were, from a return standpoint, than if you were to invest in a Class A asset. So this is typically a newer built asset, usually within the last 10 years or so, in one of the best locations in town. So maybe it's downtown Madison, for example, built in the last 10 years, just quality renovation. So premium flooring, premium lighting, fixtures, the whole nine, right? You, from an investor, again, because there's lower risk in investing in an asset like that, should be expecting a lower overall return in that type of asset. So we try to upfront try to figure out what their expectations are from a return standpoint. MLG, we're kind of middle of the road in the sense of we are buying Class A minus and Class B assets that have some kind of operational inefficiency. And we do so because we're value add investors by nature. And so we're constantly looking for assets that we can acquire to add value to. So I'll give you a quick example. There was a apartment complex that we recently purchased out of the Atlanta market. This apartment complex was previously owned by a professional that saw a lot of success in his career pursuits outside of the real estate space. They wanted to take their swing at the real estate space. So they bought this 300 unit apartment complex, figured they could manage it on their own. They essentially, unfortunately, ran it into the ground. So it was extremely mismanaged. And because of that, we were able to go in and acquire this asset from this owner at a much lower cost compared to where all the other assets of a similar structure and scope were trading at. So for real numbers, we purchased it at $140,000 per unit, where all the other assets in the area were trading for $180,000 per unit, just because we were acquiring this inefficiency. And we, as a company with 35-year track record, we know how to go in and fix the issues and again, make old new. And now we're going to be able to sell for a higher value in the future by fixing those issues. So
Cool.
So yeah, to circle back on your question, I know it was all over the place, but ultimately, yeah, we try to get on the same page with what their return expectations are, and then talk them through what we do and if we're a match for what they're ultimately looking for.
So you mentioned earlier on that speaking about being a lower risk group. So that's everything that you just said there. Like, are there any other ways that you guys are a lower risk group and a high reward group?
Yeah, absolutely. One of the other ways is from a leverage standpoint. So leverage is typically a phrase that we use throughout the industry, but just meaning how much debt that you're utilizing to finance the asset. If you think about your single family home, typically you're putting a 20% down payment on it, and you're taking out 80% of a loan to value loan from the bank. We call that 80% loan leverage. So most groups throughout the industry are actually very similar to most homeowners in the sense that they are using anywhere from 75 to 85% leverage on their transactions, which typically means that you're going to have a lower debt payment than someone that's taking out 100% loan, right? Because you're only taking out 80%, but you're also going to have a higher debt payment than someone that's taking out 60% loan. So your ability to service the debt is the risk. But there's also risk in buying an asset with all cash, because then now you're not utilizing leverage, you're solely doing a cash outlay. And while that reduces the lender risk completely because you have no debt service, you also are limiting the potential upside that you could have by utilizing long-term fixed rate debt, for example, through a loan from a bank. So as a group, we're typically hovering around the 60 to 65% leverage point, because we do believe in the power of leverage. However, we do believe that too much leverage could be a bad thing, especially in times of economic turmoil, to where you might have rising costs or expenses at real estate assets, or you might have periods of reduced net income that's produced at the asset. If you ever are faced with that, now, because we're lower levered, we have the ability to weather the storm, right? We can absorb a higher amount of net income loss compared to someone who is higher levered. They're going to find themselves underwater, and unfortunately, if they are underwater for too long, then the banks can foreclose and seize those assets.
What would you consider the biggest, what is the biggest priority when it comes to setting the client's expectations? When you're speaking to them, what's the biggest risk that you want to hammer home in their heads that could potentially hurt their investment?
I think asset allocation is 100% the most important decision for anyone to make. And so if you are, for example, 100% in Tesla stock, you are on a roller coaster ride, right? Your asset allocation is zero, right? I'm riding the wave of Tesla for the good and the bad, right? It's a wave. But now you're like, okay, I want to dial back my risk. I understand that there's volatility in that Tesla stock, so I want to go with an index fund, right? So now I'm in the public market, but I'm diversified over an S3EP 500, for example, right? To where best 500 companies in the country, and that's reducing my risk level. But you're still exposed to just the stock market, just equities, right? I think real estate is a way to add in some diversification into that picture, right? Whatever your portfolio looks like. And I know you guys, and I would love to throw the question back around you of how you guys think about asset allocation for your clients. But from what my experience is I'm usually hearing that there's a bond allocation for some kind of fixed income asset, then there's equity allocation, and then there may or may not be the component of alternatives thrown in the mix as well. But I think that it's critical for investors to be thinking about adding alternatives into their investment portfolio. So I just offer them to think about if they are reducing their overall exposure through asset allocation.
Well, it's funny that you mentioned asset allocation, because we did actually, for our listeners, we did actually just do a podcast that was released this past Friday on what we call asset mapping. What we call it financial asset mapping. And we do touch on this topic with private equity, private real estate, about how you should think about fitting that into your overall asset allocation framework. And so it's quite a listen. You should take a listen of it yourself if you like.
Absolutely. I was just going to ask if you're able to give like a brief synopsis.
Oh, sure. So
super intriguing.
I got to be careful that I don't ramble, because otherwise our editor Ying is going to cut all this out, and then I'm going to get scolded later after that because I rambled. Okay, so asset mapping. The main point is to establish a threshold that we have done internally, and then from there you want to imagine a champagne pyramid, and you want to fill the champagne glasses, and you want to make sure that the top ones are all filled before they start filtering down to the bottom. So you think about your emergency fund, your cost of living, the critical things that are critical to you, because everybody's different. So Giorgio, you are very comfortable with real estate. So we might typically recommend that a private investment champagne glass should be maybe, I don't know, from 5 to 20%. And that could incorporate private real estate, that could incorporate investments in private small businesses, et cetera. But perhaps for you are more comfortable with having more than 20%, and it could all be in private real estate investments. And that's okay for you, but maybe for the average Joe, that doesn't quite make any sense. So that's where we kind of touch on that whole concept of asset mapping. But really what it anchors on is the concept that it's pertinent and unique to you. Everybody's different. You don't have to keep up with the Joneses next door to make sense for you. It's really what I like that. That's what I think.
That's incredible, Nathaniel. I feel like that's so unique from at least most of the messages that I hear from wealth managers is it's not aligned with that. And I resonate with that a ton, because everything should be very specific to individuals, right? Because you are a very unique person with unique skill sets and capabilities. So I should be targeting your specific asset allocation based on, again, your comfort level, your capabilities, your understanding, everything, all of those components. So that's incredible that you guys just had that podcast and that you guys do that for your clients.
But honestly, Giorgio, I think I'm going to bring us into our round robin and just kind of speak our last thoughts or final thoughts. And as always, we will give you the last say here, as we typically do. I'll start us off and kick it. My final thought, I feel like I got a lot of different things floating in my head on this one. But what I think my final thought is that I just appreciate you actually educating our viewers and audience on private real estate. I think it's an important thing that a lot of people just aren't aware of. And I read a really, really good article. I talk to about the firm all the time out of UW-Madison, and they speak to financial, not liter, or hold on, let's see, let me think back. They speak to financial vulnerability. So the article and the subject was financial vulnerability, and the way that they break it down is that people are financially vulnerable can be financially vulnerable from a qualitative and a quantitative standpoint, right? So when you're looking at financial vulnerability, just because you have a lot of assets doesn't mean that you're not vulnerable over time, because you could be subjectively vulnerable, which means you have a lack of awareness or a lack of literacy when it comes to finances. And so that is the point. Even though people who may be coming to you are high income earners, or they may be people that have more quote unquote money, so they may be more quote unquote secure, it is still important to be educated on the decisions of your real estate allocation, which there is more out there than just a publicly traded REIT. That could be beneficial for you, as both you and Nathaniel just explained. And so that awareness and that literacy can actually help you de-risk yourself from a financial vulnerability standpoint. So I just really appreciate that you kind of educate the group on the structures and different things. And it's always been a pleasure to talk with you too. So thank you. And Nathaniel, I will kick it back to you.
Setting the client expectations, I think, is huge. Not only finding the right person for the investment, but making sure that they understand what it entails. It's not. I agree that asset allocation is very important, but I think that liquidity is also just as important, personally, from what we've seen with our clients. Because when a client comes to us and they say that they want to invest in real estate, and they want to, I mean, there's also the do-it-yourself. They want to take all that on. They want to take the calls at midnight when their plumbing stops. All the more power to you.
So they say.
But so they say.
Yeah, until they experience it.
When they want to get out of it, it's the liquidity that I've always found to be fascinating, because people have seen the historical rates of return for real estate, and they see it as a solid asset that can't be moved, it can't be lost, it can't be, it's hard to steal, but I'm sure it happens. But it's a very illiquid asset. And to your point about leverage, when looking at other REITs or REIGs out there, potential investments you can invest with, and investing vehicles that you can invest with, understanding what your liquidity is and the leverage is, I think are very important factors that you brought up, that I think that all investors should be aware of. Giorgio?
Yeah, I love the points that both of you made and highlighted here. There's so much to this space, and I mean, this is why I love it. The biggest thing, obviously, over the last 10, 12 years, we've been in an upcycle in real estate. And the thing that I want to leave everyone with is, and this is a big reason to why I love real estate so much, is it's not as efficient as the public market, right? Because you can't trade in and out at any given second like you can in the stock market, right? And there's a lot of human error involved at every component, just like the example I gave with a professional who had a lot of success in a different career, and they wanted to try their skin out in acquiring and managing their own apartment asset. There's a lot of human error, and that can be found in both good and bad times. And I love private real estate because of that. You can always find inefficient assets to acquire great investment opportunities. But the one tip that I would leave everyone with is the world of private real estate is so vast. And I know we've covered a lot here today, but there's so much to know and to understand. And so I'm happy to connect with anybody and walk you through other components other than what we just talked about here today, and really help you get educated in the space before making the decision of, do I want to be active in real estate? Meaning, I want to be the one receiving those phone calls and doing the plumbing, or do I want to be more passive? I mean, me and my wife have done both. And to be quite honest, we are very much happy with our decision to shift from being active to being way more passive and just having, we call it mailbox money, but essentially just money that comes in every month or every quarter. And we didn't have to do anything in order to do that. We didn't have to take the phone calls. We didn't have to fix anything. And it's much better than the active management of real estate. So that fits for us. But ultimately understanding where you ultimately want to go, or the path that you want to take within the private real estate space, based on what makes the most sense for you. So I'll leave it there. Happy to connect. My email is jhopkins@mlgcapital.com. If anyone wants to send me questions or connect there, happy to do so.
So with that, thank you, Giorgio, for speaking with us today about private real estate. For our listeners, our viewers, our audience, thank you for listening, and we hope you have a good night.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.